Welcome to Taking Stock for the week ending 4th of November 2022. I hope you and your families are all holding up well in this magnificent yet sometimes crazy world we live in. I'm Tim Lincoln, and joining me today is our Head of Stock Doctor Research, Kien Trinh, to stream to you all things share market. Hello Kien, how are you?
I'm great, Tim, and it's great to be here. I can't believe the month of October has come and gone so quickly.
I can't believe 2022 has almost come and gone so quickly, Kien, but yep, that's life, isn't it? But before we get started, Kien, we just need to remind all of our members and guests that the information we provide today is of a general nature, and obviously we haven't taken into account your personal situation or needs, and all of the data and performance figures that we share are of an historical nature and therefore should not be relied upon as a guide for future performance. Well, October, hallelujah, Kien, was a big month for equity markets, with the All Ordinaries Accumulation Index up some 5.7%, a stark contrast to the doom and gloom that came through during the month of September. And positively also, Kien, the collective model portfolios of both Star Growth stocks, who are up some 6.3%, so outperformed the All Ords, and our Star Income stocks were up an incredible 7%. So, Kien, what led to that very, very positive outperformance?
Yeah, many of our star stocks did exceptionally well, Tim. Stocks like, for instance, PWR Holdings, even the REITs, or the listed property Arena REIT, they rallied very strongly, up about 19 or 18%. Then you have the retailers, Adairs Group and Super Retail Group. They all reconfirmed their guidance and they rallied quite well as well, up 17%. Not to mention the banks, they were also up 17% for the month. But again, I think the theme last month was market volatility created that opportunity, Tim. You know, you had fears of a global recession, and that appeared overdone, with many companies reporting better than expected numbers. In fact, 71% of companies in the third quarter US reporting season beat or met expectations. Meanwhile, here in Australia, most companies reconfirmed their earnings guidance within the AGM despite margin pressures.
Yeah, that's right, Kien. And as a result, earnings expectations have held up quite well, contrary to market expectations. Banks tend to be the barometer of the economy, and the bank's results, both here and in the US, revealed an improvement in net interest margins, with bad debts well and truly under control, which is great. For example, here in Australia, Kien, ANZ revealed a rise in their net interest rate margins from 1.6% to 1.7% in the second half of their financial year. With the unemployment rate at record lows now, the proportion of home loans in arrears, and they're the loans that have missed more than 3 loan payments in a row, have tended lower from 2.5 to 2% on the back of, as I said, that lower unemployment rate. This should support the sustainability of ANZ's dividend yield, currently at a very, very attractive 8.6%. The bank is expected to go ex-dividend early next week, Kien.
Yes, rising interest rates can benefit banks because they tend to revise up their loan rates much quicker than what they pay out in deposits, Tim. And this week, the RBA increased the cash rate by another 25 basis points to 2.85%. That's the cash rate now. And they do expect further rises to come. And as you can see from the chart on screen, cash rates are expected to top out at around 3.9%. And this compares to the forecast peak rates as high as 4.4% last month. And if the global economy begins to contract, though, central banks could potentially cut interest rates next year, Tim.
Okay, all sounds very interesting, Kien. But what does it really mean over the medium term for the share market?
Tim, in general, slower than expected rises in interest rates tend to benefit growth and quality stocks, but we don't know what the future brings, really. And trying to time markets by forecasting these macroeconomic conditions is really a fool's game. In the words of legendary fund manager Peter Lynch, he once said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the correction themselves, Tim."
Yeah, very wise words from one of our great investors of all time, Kien. You need to take heed of that, that's for sure. But the key message there is that we should separate the facts from the noise, Kien. Ideally, select stocks and construct portfolios based on quality business fundamentals. That is, pay attention to the financial health for peace of mind, especially with corporate failures increasing. More on this in question of the week. And past financial performance, golden rule 2 for proven growth and income track records. And then golden rule 3, outlook, guidance, and active risk to increase the probability that the company will continue to grow or continue to deliver on that sustainable dividend. And the AGM season has provided us with insight on how companies are performing, Kien, and earnings have held up quite well, which is really reassuring. Even across the interest rate sensitive sectors like retail, with recent data continuing to show an increase in consumer spending. And with market volatility caused by macroeconomic fears can lead to exceptional opportunities. For example, the recovery across our star stocks last month with a classic example of how quality, income, and growth can rally sharply, rewarding investors who saw the opportunity. Speaking about opportunities, Kien, during the week, Star Income stock and fund manager Perpetual received a takeover offer from private equity for its shares at $30 per share. That's an 11% premium to its last close price prior to the takeover offer of $27 a share. Not surprisingly, Kien, the Perpetual board rejected the offer on the grounds that it undervalued the business. So, Kien, how does this impact its dividend yield going forward potentially?
Yes, Tim, there's a lot of moving parts here. This takeover offer comes after Perpetual convinced rival fund manager Pendal Group to agree to a merger in August. So the merger allows the combined business, remember that merger in August, it allows the business to compete against the onslaught of low-cost passive fund managers. However, the risks associated with the merger meant that we had to remove Perpetual from borderline star growth status in September. And these risks, include overpaying for the business, for instance, integration risks, management capability, and also retention of key personnel as well. And this is the reason why short interest on the stock has risen sharply to 8% over the last few months. However, from an income perspective, we do believe the forward gross dividend yield of around 8%, it provides a safety margin in the event earnings do deteriorate. In Perpetual's recent first quarter update, earnings held up pretty well despite the market volatility, with around about 93% of their funds outperforming the market over the last 3 years.
Yep, fairly interesting there, Kien, and a lot of moving parts, but let's watch your space and see what happens with Perpetual. But moving on to the healthcare sector, Kien, and borderline star growth Resmed provided a solid update to the market for its first quarter in 2023 financial year. Remember, Resmed designs and manufactures medical devices to treat breathing and sleeping difficulties. Despite elevated costs resulting from higher wages and travel expenses, Kien, how did Resmed increase its profit margins?
Yeah, this is such a high quality stock, Tim, with such a strong market position that they were able to increase their margins by raising average selling prices. And also, they had very strong sales growth of about 18% in the Americas region. Moreover, though, Resmed could potentially gain market share from competitor Philips global equipment recall. That happened recently as well. So coupled with easing supply chain pressures, as noted by management, the stock has experienced double-digit earnings revisions over the last 3 months, Tim. And now, moving on to our corporate calendar, Star Income stock, Westpac, is expected to report its annual results on the 7th of November. And then you have Star Growth stock, James Hardie as well, the buildings material company. They should report their interim results on the following day. So that's going to be interesting with interest rate rises, see how that affects construction and activity there. And of course, borderline Star Growth stock and Star Income stock, National Bank, NAB, is due to release its result on the 9th of November. In terms of dividends, ANZ and Macquarie should go ex-dividend on Monday, the 7th of November as well. And also, of course, AGM season will be closely watching Nine Entertainment Group and also REA Group next week.
And now to Under the Microscope, Kien. And this week, we have a look at Macquarie Group. For those who are unfamiliar with Macquarie, the company is called Australia's Millionaire Factory due to its reputation for paying very healthy remunerations to its senior leaders. The company has operations across asset management, 33% of first half 22 earnings, the banking services division, 12% of earnings, commodities, 43% of earnings, and investment banking, 12% of earnings. So, Kien, the company released its first half 23 result late last week, and its earnings were ahead of consensus estimates, which is great. But what is driving the large disparity between its FY23 revenue and earnings growth forecasts?
Yes, Tim, under Golden Rule 3, you can see that disparity quite clearly. But revenue is expected to be 31% higher, and that's due to the commodities and also global markets division. This is the biggest contributor to their earnings, Tim, as you mentioned, at 43%, and that's benefiting from volatile commodity prices. In addition, the banking division at 13% of total earnings is performing well on the back of higher interest rates. However, consensus is forecasting earnings per share decline of around 10%, and that's due to the increased number of shares on issue from the 2.8 billion capital raising it did towards the end of 2021. And this is also expected to dilute its return on equity and could potentially mean that the stock may be removed from Star stock coverage when it reports in April next year, Tim.
Yeah, that return on equity figure, we've got to keep a close eye on that. So as we move through, though, Kien, this in-between reporting seasons, obviously you and the analysts will keep a close eye on that because they could be revised up and they end up achieving that threshold. But yeah, got to watch this space on those key factors for Star stock criteria. But Macquarie is also a Star income stock, Kien. And with its yield trending around currently at around 4.5%, is there enough buffer to cushion the dividend in the event in a slowdown in market activity, Kien?
Yeah, that's quite a lower yield, Tim, but it's still in line with the market. But that low yield on the stock really is reflective of Macquarie being more of a growth story than an income stock, although there is a risk that dividends could be reduced on the back of deterioration in market conditions. For now, though, we believe the dividend yield is sustainable, and that's on the back of, you look at this stable earnings trend over the last 3 months and longer term, you can see that rising under Golden Rule 4, but also unstretched payout ratio at 57% as well. In addition, with a capital surplus of 12.2 billion, there is sufficient buffer for the company to sustain their dividend payments in the short term, Tim.
Yeah. And what I'll always like to see, Kien, as a real bonus is when high quality stocks like Macquarie, especially from a growth perspective, are trading at a discount to its consensus share price target, which it currently is under Golden Rule 5. So is that representing a bit of an opportunity at the moment for investors?
Yes, Tim, we'd like to see these quality stocks trading at a discount, but of course, it could represent opportunity for investors who want to take advantage of the current market environment and gain a foothold on this quality growth company. And with the surplus capital, remember the company should be able to, they are in a very strong position to capitalize on distress opportunities in the event of a market downturn. So that's going to benefit them as well. However, investors should ensure that they have a long-term investment time horizon, given that earnings are tied to the global economic conditions.
Yep, for sure, Kien. And from a leadership perspective, great to see the CEO is performing well. Obviously, the company's achieving its growth metrics and income distribution objectives for shareholders. So obviously, she's performing very well. And it's also great to see that Shemara has strong skin in the game with a total shareholding currently worth $186 million. However, we should note that most of the stock has been allocated through performance bonus issues, which again demonstrates another millionaire coming out of the factory, Kien. However, these bonus issues that she's received that has allowed her to accumulate this quite a significant personal shareholding is justified, in my opinion, as shareholders have also been rewarded due to the strong share price performance from Macquarie over many years. And now to question of the week, Kien. And last week, Matthew Schwartz, our senior portfolio manager at Lincoln Indicators, and myself had the pleasure of presenting at the Australian Shareholders Association virtual conference about the importance of financial health, especially in a period of rising interest rates and slowing economic growth. With the level of insolvencies on the rise, we need to be especially mindful of the zombie companies. So a useful question this week, Kien, is how can Stock Doctor help members identify zombies and avoid the walking dead amongst us? But Kien, first up, what are zombie companies?
Yeah, zombies are those companies that are on the brink of collapse, usually with significant debt and very little cash flows, Tim. They are called zombies because their financial situation is so weak that, as you categorize, Tim, they are the walking dead. But to identify the zombies on Stock Doctor, we can combine the financial health model with two additional metrics in the Stock Doctor filter tool, which looks at the ability of a company to pay off its debts, really. First is the interest coverage ratio, which really measures how many times a company's operating profits can cover its interest payments. A zombie company tends to have an interest coverage of less than 1 time. Second is the net debt to its operating earnings, otherwise known as the net debt to EBITDA ratio. And a value greater than 2.5 times here means that the company is at high risk. So our financial health model is then used to complement these debt factors by looking at the overall relationship between balance sheet liabilities, the assets, the cash flows, and also the profits.
Yeah, wow, thanks, Kien. There certainly are some very well-known companies and interesting names on the list, aren't there? But it really does showcase the core power of Stock Doctor, being the financial health model and Golden Rule 1 as being the core criteria, and then extending out to create the list by using some of the other criteria that are available in the stock filter. So great stuff. Thanks for showcasing that. And wonderful, as always, sitting down and having a chat to you.
It's a pleasure, Tim, and let's hope, the month of November will do well for our star stocks.
Well, who knows, Kien, because the market is still incredibly volatile on a daily basis. And while inflation remains unstable and rising and interest rates continue to rise, the market volatility will continue to remain. So we look forward to, in a few months' time, whether it be 6 months or 12 months, inflation rates and interest rates to stabilise, and then hopefully there's some smoother seas ahead. But remember to separate the facts from the noise. I think that's absolutely critical. Focus on constructing portfolios and selecting stocks based on that bottom-up quality fundamental perspective. And we believe through our golden rules that's the framework that we provide. Indiscriminate selling due to fear creates opportunities. So quality companies, when they are oversold, and that can create opportunity. But then again, if you are trend sensitive, SD30 TSR is performing beautifully also in this environment. So if you prefer to sit on that little bit of cash and avoid the volatility and then re-enter once the stock momentum recovers, then that's another option. And manage your risk by avoiding those financially unhealthy businesses and some of the names on the list that Kien showed, as they are zombie companies and potentially the walking dead. But that's it for another week, Kien. Thanks a lot, and thank you all for tuning in. Take care and have a happy, healthy, and prosperous week.